Hi, I'm Alan Zhang, one of the partners at Ox Capital. Honored to be here and introduce our proprietary Macro Overlay Aggregate Tracker, or MOAT in acronym. The MOAT is a reductive quantitative model which pulls over 1 million financial, economic, and price data points on each run. We then distill this information down to a few pages and make it cohesive and insightful. The model is conclusive yet bottom-up because most data are extracted company by company instead of it being macro data points or layers of estimates, which sometimes can be noisy. The whole overarching idea of the MOAT model is to allow us to follow the money in the economy and the financial system, or whether in fact there are more money in the system. Let me first stress that we are a team of stock pickers. And our bread and butter is still to identify future champions when they are underdiscovered or underappreciated. But the MOAT is a tool we integrate into the investment process to make us work more effectively by having a realistic view of the global economy without presumptions by journalists or media companies. And it's been helpful in the past few years, I have to say. It's helped us avoid the downside during COVID-19 in 2020, the semiconductors decline in 2022, and it helped us acquire some early exposure of Indonesia before others started to appreciate it. And let me dig into more details. So during COVID, it warned us about the severity of the profit downgrades alongside with the contagion analysis that we were running at the time with Dr. Joe. We were speaking with businesses all over Asia, and some were preserving more than 12 months of capital in preparations of the COVID uncertainties. But at the same time, we were also seeing some news about COVID just being another flu all over the media, and the global markets were not too concerned. And, sooner or later, we then, of course, saw the lockdown and the EPS downgrade across the board. And in the second quarter onward, despite the lockdown, we saw the synchronized loosening by all major central banks and earnings improvements of the cyclical sectors from the MOAT. It helped us build conviction of the sharp global economic recovery and the upcoming inflationary pressure. But at the time, the market was still panicking. So we saw this as an opportunity to buy. And with that, overall, in 2020, we did most of the right things. We avoided the early sell-off, profited off the work-from-home beneficiaries early, such as e-commerce, sportswear apparel, and got into the cyclical sectors in the second half. And in late 2021, we also detected early signals of Indonesia's economic improvement and positioned for it by buying the best quality Indonesian stocks. The market turned out to be one of the best performing assets in 2022. I think our semiconductor positioning in 2022 can be rather illustrative. So in late 2021, the MOAT showed us some early symptoms of developed markets slowing down with the retirement of COVID stimulus. The team actually follows the semiconductor industry very closely, and we observed that the demand for digital products was losing some momentum after a period of over-indexing from the government handouts. And these insights coincided with our MOAT EPS downgrades in the semiconductor industries across US, Taiwan, and South Korea. And most data points we tracked pointed to weakness. Yet, most related stocks and industries were still performing. We then hedged our exposures in the related industries, which yielded, honestly, great results in 2022. The SOX Semiconductor Index went down nearly 50% through the year and ended 2022 at negative 35%. So the MOAT showed us credit creation was slowing down, hence the economy. Meanwhile, the EPS revision in countries where semiconductors play a big role were weak. And the MOAT acted like another unbiased reference point that we can use to compare with the mainstream media. To be honest, had we seen a much stronger global economy from the MOAT, like the media was saying at the time, we probably wouldn't hedge as much. And it is important to point out that the model is not stale. It's constantly being reiterated as the framework advances. And I'll give you an example. As the thematic of China plus one becomes more prominent and localizations of equipment and whatnot, we start to monitor the improving earnings as a result of diverted capital into ASEAN and LATAM countries. After all, the core concept of the MOAT is to allow us to follow the money. The model is actually telling us quite a few things, but I'll keep it brief. The overall credit withdrawal in the United States will continue to slow the economy and lower inflation. The banking industry in the US may experience some minor stresses caused by the tightening, but the overall financial industry will remain rather resilient. The US will enter a rate cut cycle regardless of the pace and timing. This is actually not a bad thing for emerging market equities. In fact, we think this is an ideal risk-on setup for emerging market equities, especially when the starting valuation is extremely attractive. And the country I think we should pay close attention to are Brazil, China, Indonesia, and Vietnam. These countries will experience improving growth, accommodative domestic policies, and low inflation.